Good afternoon, ladies and gentlemen. Let me welcome you all to Central Bank of Nigeria. The Monetary Policy Committee met on the 26th of continued macroeconomic uncertainty, but gradual improvements in the domestic economy. The committee appraised the developments in both the global and domestic economies, as well as the outlook for the rest of the year and the first quarter of 2020. All the 11 members of the committee were in attendance at this meeting. Monetary Policy Committee reviewed the achievements of monetary policy in 2019, gradual improvements in the domestic economy, particularly price stability, the development improved credit delivery, and low interest rate regime, as well as the exchange rate stability and the financial system stability, reduction in non-performing loans of the committee were in job creation and output. At the first meeting in January 2019, the committee retained the monetary policy rate at 14%. In March 2019, it reduced the MPR by 50 basis points to 13.5% and held other parameters constant in the first 10 months of 2019. Committee noted the use of homegrown heterodox policies used by the bank to successfully achieve substantial macroeconomic stability in 2019. Among the policies were the use of the Global Standing Instruction GSI to address the predatory impact of serial borrowers in the banking system, a phenomenon that reduced the level of NPLs over time, the loan-to-deposit ratio to post-credit delivery by the deposit money banks to the real sector, discounted cash reserve requirement, development finance initiatives in the agriculture, micro, small, and medium enterprises, and other real sector activities, including restriction of patronage by local corporates and individuals, investors in the CBN open market operation bills. The global economic environment. Global output growth remained weak due to the impact of the trade war between the US and China, growing vulnerabilities in the financial markets, downturn in global manufacturing, sustained volatility in oil prices, lingering uncertainty around the Brexit, which has continued to dampen investment growth in the United Kingdom, subdued growth in the European Union and Japan, and dampening output growth in China. These headwinds resulted in slowing global trade, weakening aggregate demand, and contraction in the aggregate supply chain. Major emerging markets and developing economies, particularly China and India, also slowed, while South Africa, Russia, and Brazil recorded even slower than expected growth. Consequently, there was a broad slowdown in global output growth. In the light of these developments, the IMF revised global growth forecast downwards to 3% in October 2019, from its previous projection of 3.2% in July 2019. Inflation in most advanced economies remained well below their long-run objectives, with price development staying subdued and unemployment trending mostly below the non-accelerating inflation rate of employment, NAIRO. In the US, wage growth and aggregate demand continue to perform below the long-run average, even though unemployment remained below the non-accelerating inflation rate of unemployment. Consequently, the recent trend towards monetary accommodation by key central banks is expected to continue into the foreseeable future. In key emerging market and developing economies, however, prices trended upwards with the output gaps widening and unemployment remaining relatively high. Domestic economic developments. Data from the National Bureau of Statistics showed that real GDP grew by 2.28% during the third quarter of 2019, compared to 2.12% and 1.81% in the preceding and corresponding quarters, respectively. The improved growth was driven largely by performance of the oil sector, which grew by 6.49%, while the non-oil sector grew by 1.85%. The manufacturing and non-manufacturing purchasing managers indices also expanded for the 31st and the 30th consecutive months at 58.2 index points apiece in October 2019. Staff projections indicate that real GDP during the fourth quarter of 2019 is expected to grow by 2.38% in the oil sector. Headwinds to these projections include continued high level of unemployment, mild resurgence of anticipated inflationary pressures towards December festive season, rising public debt, high level of insecurity, and slow pace of oil price recovery. Despite these headwinds, growth is expected to pick up on the back of recent actions to boost credit to the private sector through the recent loan-to-deposit ratio and global standing instruction initiatives, sustained interventions by the bank in selected employment and growth-enhancing sectors, as well as fiscal policy measures to support growth. The committee noted the uptick in headline inflation year-on-year from 11.24% in September to 11.61% in October 2019. This was anticipated as part of the seasonal end-of-year uptick in prices, but was further accentuated by the border closure and expected temporary food supply shock, which will adjust over the medium to long term as the economy increases investments in food production. Consequently, food inflation rose from 13.51% to 14.09% in September and October 2019, respectively. Core inflation, the underlying inflation in the economy, however, declined marginally from 8.94% to 8.88% in September and October, respectively. The decline observed in core inflation was attributed to the relative stability in the foreign exchange market. The Nigerian land borders were closed to address the incidence of increased cross-border banditry, smuggling and dumping, insurgency, and the illegal trade practices of neighboring countries whose economies had become dependent on Nigeria through smuggling through our borders. The bank's continued intervention in the agricultural sector is expected to improve medium-term food supply. Indeed, there has been reports of bumper harvest in some staples like rice, maize, to mention a few. Committee observed that broad money supply M3 grew by 5.72% year-on-year in October 2019, compared with 2019 indicative benchmark of 16.08%. Growth in net domestic credit moderated to 26.38% in October 2019 from 30.33% in the previous month. This was attributed to a significant reduction in credit to government in October 2019 to 85.99% from 114.79% in the previous month. Growth in credit to the private sector, however, improved to 13.08% in October 2019 from 12.49% in the previous month, reflecting the impact of the bank's recent policy on loan-to-deposit ratio. An increase in the absolute gross credit amounting to 1.169 trillion naira was recorded between the end of May and end of October 2019. Consequently, the manufacturing sector received 459.69 billion naira, the highest in 2 decades. This was followed by the consumer loans of 356.65 billion naira, general commerce 142.98 billion naira, information and communication 82.07 billion naira, construction 74.52 billion naira, agriculture, forestry and fisheries 73.20 billion naira, mining and quarrying 3.64 billion naira, and transportation and storage 3.09 billion naira, among others. The committee therefore urged the management of the bank to sustain its current efforts to improve lending to the private sector and to explore other initiatives to provide funding to other critical sectors of the Nigerian economy. In the review period, money market interest rates reflected the prevailing liquidity conditions in the banking system. Overall, monthly weighted average interbank call and open buy fell to and 7.22% respectively in October 2019 from 11.41 and 10.73% respectively in September 2019. The committee noted the persisting bearish trend in the equities market had started to abate in November 2019 and was pleased by the increased patronage in the sovereign bonds market. The all-share index grew by 2.41% to 26,991.42 index points on November 22, 2019, from 26,355.35 index points at the end of October 2019. Market capitalization also grew by 1.4% to 13.03 trillion on November 22, 2019, from 12.83 trillion at the end of October 2018, due largely to portfolio shift from government securities to the equities market. The MPC also noted the improved resilience of the banking system as the non-performing loans ratio declined further to 6.56% at end of October 2019 from 6.67% as of September 2019 and from 14.05% in October 2018. The committee, however, noted that this figure remained above the prudential bank benchmark of 5%, thus urging the bank to sustain its current efforts, which have created this exorable prudential regime. Outlook. Overall, the medium-term outlook for the domestic and global economies remain to be clouded with uncertainties associated with the persisting trade wars between the U.S. and its major trading partners, financial vulnerabilities, rising levels of public and corporate debts, pockets of geopolitical tensions, and weakening global output. However, the reforms underway in the domestic economy aimed at diversifying the economy away from oil over the last 3 years have provided adequate shock absorber to withstand the headwinds. However, the committee urged the fiscal authorities to invest massively in public works program and improve fiscal buffers to complement these efforts. Forecasts of key macroeconomic variables, however, indicate prospects of improved output growth for the economy. Based on recent revised projections, the economy is expected to grow in 2019 by 2.3%, IMF estimate, 2.1% by the World Bank, and 2.2%, the CBN staff estimates. Committee noted the tailwinds to these developments to include sustained stable exchange rate, enhanced flow of credit from the deposit money banks to the private sector, expected improvements in tax revenue and efficiency in public expenditure, continued improvements in the business environment and activities, and the sustained intervention by the bank in the real sector. Committee's considerations. The committee welcomed the improvements in output growth in the third quarter of 2019, noting that the current direction of Purchasing Managers Index suggests stronger growth in the fourth quarter. It, however, re-emphasized the need for diversification to strengthen the productive base of the economy and reduce dependence on oil. Diversification has become necessary now that Nigeria has signed the African Continental Free Trade Agreement, AfCFTA. To achieve this, the committee urged the federal government to continue to improve the investment climate and ease of doing business to attract foreign direct investment. Particularly, the government should, as a priority, improve conditions for global auto manufacturers, including for aviation and rail industries, to invest in the country. The committee commended the expansion in manufacturing output, noting that it was a direct fallout to the policy on loan deposit ratio. The committee called on government to urge the Pensions Commission to improve the prudential requirements for pension funds to refocus their investment portfolio away from their traditional choice of government securities in favor of other viable long-term investments in real estate, manufacturing, agriculture, and indeed infrastructure. Moreover, the committee called on strong visibility of fiscal and structural policies to improve infrastructure and investment conditions in the economy. It expressed strong optimism that the current policies of the bank, in a regime of solid fiscal and structural policy support, will yield strong dividends in closing the current negative output gap in the medium to long term and place the economy on a sustainable and self-sufficient path of growth, of output growth. As a key pillar of economic diversification, the MPC directed the attention of fiscal authorities to the immense potentials of the gas subsector and the urgency to encourage horizontal integration through private sector participation. This, the committee argued, will improve domestic power supply and export earnings. On price development, committee considered the moderate uptick in headline inflation in October 2019, attributing it partly to an expected temporary shortfall in food supply because of the recent land border closure and rise in demand as the festive season approaches. Although it noted that the price increase was not unexpected, it serves as a cost of the closure, which is lower than the medium-term benefits. Consequently, it noted the need to drive down food prices through increased support for local production of staple foods, including rice, fish, poultry, palm oil, tomatoes, and etc. It also urged government to follow through with a sustainable policy on backward integration in the milk industry and other priority sectors of the economy. On the fiscal sector, committee identified the need for institutional reforms through policies that would automate day-to-day processes of key revenue-generating and security institutions such as the Nigerian Customs. This will provide additional advantage of stemming smuggling, kidnapping, and the migration of terrorists into the country. The MPC reiterated the need for increased efficiency in public expenditure and the building of fiscal buffers. On the impact of the recent closure of the Nigerian land borders on domestic food prices, committee noted that any upward price movement arising from the closure was reactionary and therefore temporary. Moreover, significant investment has been made over the last 3 years to sustainably increase domestic food supply. It noted some of the key initiatives in this direction to include the commodity development initiatives designed to finance the agricultural value chain of 10 commodities, namely cassava, cocoa, cotton and textiles, rice, tomatoes, poultry, livestock and dairy, fish, oil palm, and maize, which has received 171.6 billion naira in funding. 4 of these crops received over 140 billion naira, or 81.6% of total disbursements, cassava 11.4 billion naira, cotton 40.47 billion naira, rice 53.4 billion naira, and oil palm 34.81 billion naira. It is therefore expected that the outcome of these interventions will close the supply gap already envisaged in the medium to long term, including dampening domestic prices. It therefore expressed support for the temporal closure of Nigeria's land borders, noting that securing the country's land borders should be further enhanced. On crude oil price, committee noted the lull in the futures market, suggesting that prices will remain relatively weak into the foreseeable future. The committee therefore urged the federal government to reconsider its 2020 budget oil price benchmark of $57 to the barrel to build buffers. Committee was confident that despite the weaknesses from the external sector, efforts to ramp up domestic production through several measures by both the monetary and fiscal authorities will douse the adverse effect on the domestic economy in the medium term through reduction of importation of food and commodities. Committee's decision. The Monetary Policy Committee reviewed the upsides and the downsides of the options to tighten, hold, or to loosen. It was conscious that while tightening may encourage capital flows, it also has the downside consequence of stifling of the already nascent recovery in output growth. The committee also noted that a reduction in policy rate will improve growth prospects, but in view of the uptick inflationary pressures, it decided that the balance of risk was in favor of protecting price stability. Considering the recovery, decline in market interest rates, growth in domestic credit amongst other positive developments, committee felt that there would be more gains in the shortfall to medium term in holding policy at its current position. In its consideration to hold, the monetary policy noted with pleasure the positive outcomes of actions already taken by the bank. These actions include the current policy on loan-to-deposit ratio, which has resulted in loans and advances rising by over 1.1 trillion naira between June to October 2019. It further noted that these actions have assisted in boosting credit to the agricultural and manufacturing sectors, hence the positive outcome on the gross domestic product. The MPC is hopeful that the loan-to-deposit ratio initiative must be sustained as interest rates being paid by borrowers have so far dropped by up to 400 basis points between June and now. These have happened with corresponding decline in non-performing loans ratio to 6.5% at the end of October 2019. The MPC is therefore of the view that sustaining the MPR at its current level is crucial for better understanding of the impetus of growth before deciding on any probable variations. The MPC also feels that holding its current policy position offers pathways for appraising the effect of the heterodox policy to encourage lending by the banking industry without varying the policy rate, as the downside risk to growth and caution on inflation looks stable. The MPC is also of the view that the improvements in the macroeconomic indicators, such as the gross domestic product, the non-performing loans ratio, the capital adequacy ratio of the banks, as well as the loan-to-deposit ratio, suggest that the current monetary policy stance is yielding results. It therefore feels that maintaining the current stance will be necessary in order to sustain these improvements. In view of the foregoing, the committee decided by a unanimous vote to retain the policy rate at 13.5% and to hold all other policy parameters constant. In summary, the MPC voted to 1. Retain the MPR at 13.5%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5, and retain the liquidity ratio at 30%. I thank you for listening.